Okay, let's take a look at section 10.3, Pro Forma Financial Statements and Project Cash Flows. So we have an example here. We have a company that thinks they can sell 50,000 cans of shark attractant per year at a price of $4 per can. Cost about $2.50 per can to make the attractant, and a new product such as this one typically has only a 3-year life. We require a 20% return on new products. Okay, to begin with, we've got 50,000 cans of shark attractant at $4 per can. Well, up here, we're going to show on our projected or pro forma income statement 50,000 units, $4 a unit, so that's sales revenues of $200,000. Then it's $2.50 per unit times 50,000 cans for our variable costs. So here are variable costs, $2.50 per unit times 50,000 units, $125,000. Then further down it says fixed cost will be $17,430 per year. And you see in the footnote, by fixed costs we literally mean a cash outflow that will occur regardless of the level of sales. This should not be confused with some sort of accounting period charge. So every year we're going to have this fixed cost of $17,430. Then it says we're going to invest a total of $90,000 in manufacturing equipment. They're assuming straight-line depreciation over the 3-year life of the project with no salvage value. So we have $90,000 per year divided by 3 years, so our depreciation, $30,000. Now when we subtract 200,000 minus 125 minus 17,430 minus 30,000, we get EBIT of 27,570. And our tax rate is at 21%, which is $5,790, and that gives us net income of $21,780. So here we have a projected pro forma income statement for this project. Now down below, we're showing that there's a net working capital requirement of $20,000 to start with. So $20,000 here. So we're going to show that as a required investment, and this is kind of a capital requirements over time, but you'll notice that we're retaining $20,000 per year every year. This is like a little balance sheet. And the net fixed assets start at $90,000. That was our $90,000 investment. But every year it's going down by $30,000 because of our $30,000 in depreciation. So we start with 90 and drops to 60, 30, and then 0. The 20 remains. So you recall that the cash flow is the operating cash flow minus the project change in net working capital, not net working capital, but the change in net working capital, and minus project capital spending. So when we go on the next page, we actually are repeating what we had on the previous page. That is, this version right here is the same as on the previous page 317. It's the same thing. But now we're showing cash flows. So recall that operating cash flow is equal to EBIT plus depreciation minus taxes. And here's our EBIT, 27,570, and here's our depreciation, 30, that we add, and here's our taxes, 5790, that we subtract, and we're left with operating cash flow of 51,780. So now in this table here, we're going to show all the cash flows that we had. So to begin with, we have 90,000 as an outflow when we buy the machine, and 20,000 as our change in net working capital. we don't have any cash flows from operations during that at time 0. It's just an outflow right now. But we have operating cash flows of $51,780 in each of the 3 years. And then in the final year, we get our $20,000 back. And you'd see down here at the end of the project's life, the fixed assets will be worthless, but the firm will recover $20,000 that was tied up in working capital. So they get their $20,000 back. That is an aspect of this that students typically struggle with. But the idea is that at the end of the project, you'll have that working capital that will gradually be liquidated as the firm goes through this project and it completes its life cycle. And so don't forget this part down here. You'll get the $20,000 back. This will lead to a $20,000 inflow in the last year. So now what we do is just add up in the columns for the different time periods the cash flows. 20 and 90 is minus 110, that's our outflow. And then we have our operating cash flow for years 1, 2, and 3, but in year 3 we also get back our $20,000 in net working capital. So that bumps it up to $71,780. And now what we have is what the book likes to do is calculate NPV using the formula version as opposed to using the calculator. So I'll go ahead and use the calculator. So I'm going to go into cash flow mode, clear everything out, and I'm going to put in my numbers. So cash flow 110,000, change signs, enter down, then 51,780, enter down, and there are 2 of them, so I'm going to say 2, enter down, and then finally 71,780, enter down, down. And the required rate of return was listed as 20%, so I'm going to go NPV 20, enter, down, compute, and we get 10,647.6852, and we'll call that 6869, something like that. And that's the same number that we show here. And if we wanted to calculate the IRR, you'll note that the text says, after some trial and error, we find that the IRR works out to be, well, we don't really have to do much trial and error. So we're just going to go IRR compute, and we get 25.76, which is their version 25.8. So that's the way this thing works. They also include a calculation for average accounting return. And for this, the net income every year was $21,780, and it's every year. So that is the average net income, since it's the same every year. And the total, the average of the book values would be, we have to go back into the previous page. The average of the book values, then we just sort of add them up and divide by 4, because there are 4 periods. So 110 plus 80 plus 50 plus 20, and divide by 4, and that gives us 65. So the average accounting return would be, and of course this is 65,000, the average accounting return would be 21,780, and we'll divide that by 65,000, and so there you have it, 33.51%. And that's it for this section, and you'll see in a minute in the next video that it gets a good bit more complicated than this one.